All right, to continue on talking about capital budgeting, let's talk about some refinements to some of our decision makers, some of the tools that we've used previously. So we'll just move along here, talk a little bit more as we go along. First of all, what do you do when two projects or several projects have different lifespans? I mean, if you kind of think about, especially net present value, because that's the most important technique we've talked about, it is the sum of some future cash flows, present values of future cash flows. So if you have one project that has 4 years of cash flows projected, and the other one has 8 years of cash flows projected, the one with 8 years has an advantage because it just has more years. So when companies are mutually exclusive, if you have to pick between two, it is frequently advantageous to try to put them on an equal playing field, if you will. So we want to figure out an adjustment to our analysis to figure out which projects are best. So here we have two projects, X and Y. They are identical projects. They have the same cost of capital, but they have different cash flow streams. One has a short time frame, and the other one has a longer time frame. You might look at this as saying that this one has less quality involved in the assets, and this one is more quality. The more quality thing is going to last a little bit longer. But if you look at the projects, the two is Project X has a net present value of $11,000, and Project Y is at $19,000. So from a net present value, from an internal rate of return perspective, from a decision-making perspective, Project Y is better than Project X. But because they're so uneven in time, we really just want to double check and make sure that that's actually correct. So there is a worksheet that you can use. It's called the Capital Budgeting Unequal Life Worksheet. Shouldn't have been a surprise. But again, we want to look at the project. So we're going to make a calculation here. Say, look, Project A gets its net present value $11,277 over a 3-year window. So if we could convert this $11,000 in net present value to a time-adjusted annuity payment, how much would we receive each year? So each year, this ANVP is the annualized net present value. It's equal to $4,500. If we do the exact same thing to Project B, its annualized net present value, or the $19,000, looked at how it could come in an equal basis each year of the project's life, is only $4,300. So Project A provides more of its net present value on an annual basis than what Project B does. And there are other techniques that we could utilize for this, but this is the simplest technique to get across so that we can get a feel for understanding. Sometimes projects are very similar, but yet they have different characteristics that require us to look at them again, if you will, to take a closer look of exactly how we're gaining this increase in wealth of the company. One of the issues we have is with the concept of options, right? Again, a real option is an opportunity that's embedded in the project that might alter the way a manager sees the project, depending on what they think the outcome would be on this additional option. For instance, we're thinking about starting a business in China. So we want to start a small business to see how that one works. So if that one works well, we'll increase size. If that one works well, doesn't work so well, we would decrease the size. So the value of that what if question is the value of the real options. So starting the business has a traditional net present value. Now we need to adjust it for the value, the potential value of these new opportunities, if you will. It's a very involved process. It is certainly not in the realm of this class to really explore how we utilize the valuation of options into determining the capital budgeting. But again, moving forward, you will hear of this somewhere in the future, I'm sure, inside your company. There are, again, lots of these options. Your book talks about them. Primarily what I was thinking about is this growth option, expanding some, but there are other options that are available that come to the company to figure out exactly when they should do things. Maybe when should they decide to cease a project or renew a project. All of those things are options that happen after the project is started. The last thing we want to talk about with respect to capital budgeting then is the concept of capital rationing. And to this point, we have talked about or made an assumption that companies can get as much money as they want. And in reality, that's probably true for most large companies. For very small companies, this is not true at all. But for big companies, if they need a large sum of money, it's unrealistic to think that they couldn't get that money somewhere. Now, they may not like the price that they have to pay, but that doesn't mean that they cannot get the money. What capital rationing assumes, though, is that most companies ignore that fact. They say, we don't care that we get as much money as we want. We are going to limit how much money we actually get. And of course, if we're limiting the funds that we receive, that means we're limiting the projects that we're going to do. So the impact will ultimately be on the value of the company, the net present value of all of the projects that are done, and ultimately the stock price that we would achieve if we could do all the projects that were good. There's one way we can do this, is something referred to as the internal rate of return approach. Essentially, what we would like to do is to create a graph that shows the internal rate of returns for our projects in a descending order. So from the highest internal rate of return to the lowest internal rate of return. Again, one of the challenges with this now is, since we're using internal rate of return, it doesn't guarantee net present value. It doesn't guarantee that the stock price will be increased to its maximum. But internal rate of return is readily available, and we can certainly analyze based on that number. So here we have some projects. Whoops, sorry, went too far. We have 6 projects. Here are their initial investments, and here's the internal rate of return. We also have the present values of their inflows, so that means we also can calculate the net present value of each project. So again, we're going to start with internal rate of return. We have a cost of capital of 10%, and we have 6 competing projects, but we're only allowed to spend $250,000. So there is a spreadsheet. It's called Capital Budgeting, Capital Rationing, CB Capital Rationing. And essentially what we do is we enter the projects, A through F, their investment, and their internal rate of return. Now what you can do then is you sort this box, you sort these assets from the highest internal rate of return to the lowest internal rate of return. So again, we know what? If the discount rate's 10%, anything greater than 10% is acceptable. So B, C, E, A, and F are all very good projects. We should want to do all of them. But the problem is we're only going to be given $250,000. So we're going to do project 1 because it costs $70,000. We're going to do project C because combined that's $170,000. We can do project E. So at this point we've spent $230,000. but we can't do project A because it's going to take us over our budget. So unless we can segment A and only do $20,000 of A, we won't be able to do project A. So under the internal rate of return approach, we would only do projects B, C, and E. So we have eliminated these two projects that, again, we know since their cost of capital, their cost of financing is less than what it costs, the return that we're going to get, they would increase the stock price, but we're not going to be able to do them because we don't have the money. This creates, here is our stepwise pattern of internal rate of returns. Here's the budget constraint, and obviously then it shows we can do B, C, and E. We cannot do the rest of them. Another way to do this is based on the net present value approach. And again, it's essentially the same project, the same process. We're going to enter the projects, rank them, sort this part of the table by net present value. So the highest net present value project's at the top. And then you can see we're going to do the first three projects. We would do C, B, and A, because those are the projects that would maximize, that we'd spend $250,000, and they have the highest net present values. Again, we're still eliminating E and F. And E was acceptable before, and it's unacceptable now. So again, they give us different answers. But it's just, both of them are methodologies in to figure out which project should we do if we're thinking about limiting how much funds we have available.